Hello everyone. Growth ETFs are some of the most important things that an investor can own, as growth ETFs allows for an investor to have accessibility to growth stocks and growing investments, which can help fuel an investor's returns. Today we're going to be looking at 5 different ETFs, 2 of them which are the same ETFs, but one has a cheaper expense ratio, and we're going to be seeing which one's the best. Over the last 10 years, the one that's performed the best has been the QQQ, which is the same as the QQQM, as both of them look at the same index of Nasdaq 100. However, if you're going to buy into this ETF, I would definitely recommend the QQQM, as it has a cheaper expense ratio of having 0.15% expense ratio compared to the Nasdaq's, or QQQ's 0.2%. One of the likely reasons the QQQM has outperformed is because of their low amount of holdings of 106 and their concentrated position in technology of about 52.86%. This is different compared to SPYG, which has a much smaller position in technology and has an increased position in consumer discretionary, and also has nearly more than double the positions. Similarly, VUG has even less positions of 169, but they do have a larger concentrated in technology. And SCHG has the highest amount of total holdings and has a similar amount of technology position to VUG. If you are looking to invest in just growth and not technology in general, I would 100% not recommend the QQ, as that's very focused on the Nasdaq. That limits people from investing into other areas such as the Visa or MasterCard, which can be seen here, as they're not invested in either. And this can be a big issue, as you can be missing out on money, cheap compounding machines, and this could limit the growth that the QQQ has over the next several years. However, that's not guaranteed that QQQ won't outperform as it has over last several years, but it does mean that in any other circumstance where technology does end up underperforming, the QQQ will almost indefinitely underperform the rest of these ETFs. Meanwhile, the SPYG also is only concentrated in the SP 500, meaning that it can't go past those 500 large companies, and it can't invest in anything else. However, I do like its holdings with many other types of companies, which QQQ doesn't have, like Costco or Visa, which I believe is really important for a company to have. But I still don't like the limited ability of this ETF, so that's why I want to break it down between SCHG and VUG. One more thing I want to get at before we go in deeper into these 2 ETFs is that when looking at growth ETFs, it is important to know that there's much more volatility in them than other types of investments. As if you look at the S&P 500 through the SPY and ETF, that has been the worst performer out of all these ETFs. This is because these other ETFs are all growth focused. They all outperform during periods of high growth. However, looking at this chart here, with the SPY as red, it was outperforming all these ETFs during the market crash in 2022, which shows its resilience during those times. I'd only recommend buying one of these growth ETFs if you do have a good long-term investment journey, as like if you're in your 20s or 30s, it'd be optimal to buy one of these ETFs. If not, if you're nearing retirement age, then it would be a good idea to look at more dividend-focused ETFs or value-focused ETFs such as SCHG. When looking at the performance of these 2 ETFs compared to the S&P 500, they both obviously outperformed, as their growth ETFs, and growth has outperformed over the last 15 years. However, when looking more specifics, the SCHG has underperformed recently, while they have outperformed compared to the VUG in the last 10 to 5 years. However, it is important that we look at the methodologies of these 2 different ETFs too, as SCHG uses the Dow Jones Large Cap Growth Index, which ranks companies based on stuff like earnings, revenue growth, price momentum, and other valuation metrics. It basically breaks it into 2 different forms of valuing growth, and the growth has been turned into SCHG, which has extremely low expense ratio and is also potentially tax efficient. It's very good for large cap growth. However, the big difference is that VUG is also focused on mid cap too. This is different, as SCHG is much more focused on large cap growth, and VUG looks in a more diverse way at also mid caps, and they're basically valued the same. However, VUG does look at more traits such as future and historical earnings growth, sales per share, cash flow price, and return on assets. And some of the companies in VUG can be both growth and value, as you can see growth companies which have become cheap. And I do believe that this makes VUG somewhat stronger, However, I still believe that SCHG focus on large cap growth gives it more stability and is better as a long-term investment, as there's lots of companies which are mid cap growth which could still fail pretty easily. However, that's just my belief, and I believe that it more determines on what you prefer. And I have SCHG as I use Schwab as my main trading platform, and it really determines on what you feel more comfortable with, as I feel like VUG might be more diverse, but it does have the risk of mid-cap growth, and it's not a pure growth play, as it does have some value-based companies too. That's why I do prefer SCHG, and if I do want something more safer, I do look at other ETFs such as SCHD, which we can go into another video. And that's my take on it. Thank you for watching.